Hello and welcome to the second session of the day with my solo 401k financial. We're excited today to discuss the $72,000 Robinhood Roth IRA strategy for solopreneurs only. Before we jump into that great content, we first got to do some housekeeping. As always, the presentation is being provided for educational purposes only. It should not be construed as tax, legal, or investment advice, nor is a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So, our goal is to answer your questions, whether on this topic or any other topics. I see we've already got a question that's chatted up, so we're going to field that right off the bat. If there are other questions that come up as we go through the slides, or if you have something else that you brought to discuss, please chat it over now so that we can be sure to get to them all. So, our goal here is always to just help solopreneurs, advisors, help them secure their retirement savings, answer questions, educate. So, we really appreciate the chance to discuss these topics. So, let's turn to the first question. Can I utilize my solo 401k to perform after tax contributions and then transfer to outside Roth IRA with Vanguard? Or do only specific brokerage houses allow this? So, wonderful, wonderful question. Thank you so much for bringing it. So, the answer in short is yes. So, let's first clarify what the role of my solo 401k financial is, which is we're a 401k plan provider. In other words, we provide the 401k plan documents. We utilize our IRS approved documents to create a 401k plan for our customers. Customers then use those documents to open up accounts at the bank or brokerage of choice. So, for example, Fidelity, Schwab, these are some of the top options where customers are opening up the accounts. And we're very hands on in helping customers open up the accounts at the bank or brokerage of choice. Now, Vanguard won't open up accounts for people that bring their own plan documents. They exited the solo 401k industry a couple of years back and they outsource any new plans to a census. But you can still have those after tax solo 401k funds transferred out of the plan to a Roth IRA, including a Roth IRA at Vanguard. So even though Vanguard won't open up the accounts for a third party plan, you could still have the accounts, for example, at Fidelity, transfer them out of the after tax solo 401k account to a Roth IRA at Fidelity so that it'll be a electronic transfer, then tell Vanguard to go and get the money from the Fidelity Roth IRA through the ACAT system. Hopefully that makes sense. Thank you so much for the great question. So if this information is helping you feel more secure about your retirement future, please like the video. That'll help us to get the word out to others like you, other advisors, other solopreneurs. So that'd be very much appreciated. Thank you so much. Okay, so now let's jump into again the content that we wanted to share, which is the $72,000 Robinhood Roth IRA strategy for solopreneurs only. Now, this strategy is for those high saving solopreneurs. So, of course, you've got the Roth IRA contribution limit. And if you're eligible to make a Roth IRA contribution because you don't make your AGI is not above the threshold. So if your AGI, if your income is too high, you can't even make a Roth IRA contribution. But even if you can, you're limited to $7,500. But with the solo 401k, specifically a solo 401k like the one offered by my solo 401k financial, you can make much higher Roth contributions via the mega backdoor Roth contribution strategy. For example, for 2026, you can contribute up to $72,000, almost 10 times the Roth IRA contribution limit. Moreover, that after tax solo 401k contribution is not limited by your income. In other words, unlike a Roth IRA, where if you make too much money, you can't contribute to a Roth IRA, there are no such income limits that apply to one's ability to make a solo 401k contribution. Now, you would need to have a solo 401k plan that allows for those after tax contributions and then also allow for the transfer out of the after tax solo 401k to a Roth IRA. So you got to work with a provider like my solo 401k financial at a minimum, that offers a plan that supports the mega backdoor Roth. Now, it's also going to make sense to work with a company like my Solo 401k Financial that has deep experience in helping customers make those mega backdoor Roth Solo 401k contributions, and also that provides the support in terms of the mechanics, the required tax reporting, etc. No one has more experience than my Solo 401k Financial with the mega backdoor Roth Solo 401k, because we were the first provider to offer a plan that supports the mega backdoor Roth Solo 401k. Moreover, we provide that compliance support. So, for example, it is a specific process that you have to go through. So, we help customers through that specific process, including preparing the paperwork to open up the accounts at the bank or brokerage of choice. We also provide the ongoing compliance support. So, when you ultimately transfer the funds out of the plan to a Roth IRA, it needs to be reported on a 1099-R. So, we'll handle that 1099-R for no additional charge. Now, what's interesting is that this Robinhood Roth IRA strategy is a two-step process where you first make an after-tax solo 401k contribution, and then you transfer the funds out of the solo 401k to a Roth IRA, which can be any Roth IRA, including a Roth IRA at Robinhood, or like with the good question we started out with, a Roth IRA at Vanguard. We're totally neutral as far as where that Roth IRA is at. Typically, when you transfer money out of a solo 401k, there are restrictions. You typically cannot transfer money out of a solo 401k until you meet a triggering event, such as being age 59 and a half. But there are important exceptions if your plan documents allow it. There are important exceptions that would allow someone to transfer certain types of funds out of the plan, even if they don't meet a triggering event. Specifically, voluntary after-tax solo 401k funds can be transferred out of our solo 401k plan, including to a Roth IRA, without needing to meet a triggering event. So you can continue to maintain the solo 401k, make contributions year after year, even if you're under 59 and a half years of age. You can still make those voluntary after-tax solo 401k contributions and then transfer them out of the plan right away to a Roth IRA. So the purpose of that two-step process is that you're first trying to take advantage of the higher voluntary after-tax solo 401k contribution limits by first making a voluntary after-tax solo 401k contribution. The limits are 100% of your self-employment income all the way up to the overall limit. That's how you get to $72,000. But then you want to move the funds to a Roth account so they can be just like any other money in a Roth account where it's got that potential for tax-free growth. So you're breaking the locks. You could think of it as breaking the locks because you don't have to meet that triggering event. Moreover, you're contributing a much higher amount. So let's compare, for example, your employee contribution limit. So you'll see some basic solo 401k plan providers that are now being forced to offer the ability to make Roth contributions because there are now mandatory Roth catch-up contributions that have to be made for those that make above a certain amount of W-2 wages. So now the solo 401k providers, even the basic solo 401k providers, are going to have to allow for at least Roth employee contributions. But if you want to be able to hit these super high limits, the mega backdoor Roth solo 401k limits, you really need to make a third type of contribution. So with our solo 401k plan, it allows for, of course, your standard employee, number one, whether that's pre-tax or Roth. Number two, employer contributions. But then thirdly, it also allows for voluntary after-tax contributions. And the ability to make voluntary after-tax contributions is the first part of the key. It's the first required step as part of that mega backdoor Roth solo 401k contribution strategy, is being able to contribute those voluntary after-tax solo 401k funds. Now, some folks will take a waterfall approach where they'll first fill up the employee bucket, then the employer bucket, before they then make whatever's left as a voluntary after-tax contribution. Others, though, will just skip the employee, skip the employer, and just make 100% voluntary after-tax contributions. And that's how you could end up, for example, with $72,000 in your Roth IRA at Robinhood, because you can contribute 100% of your earned self-employment income. whether that's W-2 wages, for example, if your business is taxed as an S Corp, or it would be your self-employment compensation if your business is taxed as a sole proprietorship, where self-employment compensation is equal to line 31 of Schedule C, less one half of the self-employment tax. Or if your business is taxed as a partnership, self-employment compensation is equal to line 14 of your K1, less one half of the self-employment tax. But as long as that self-employment compensation is equal to at least $72,000 for 2026, you can contribute 100% dollar for dollar as a voluntary after-tax contributions, just simply not make any other contributions to the solo 401k, and then transfer those funds out of the solo 401k to a Roth IRA, including a Roth IRA at Robinhood, with the only caveat that that assumes that you're not making any other contributions to a 403b. Because if you make contributions to a 403b, all the contributions that you make to the 403b, whether employee or employer, together with any contributions that you want to make to the solo 401k, the sum cannot exceed the overall limit. For example, $72,000 for 2026. Now, Robinhood for our customers can be a popular choice. Why? Because they're offering a 3% boost. And this is generally speaking. Obviously, you want to check with Robinhood as far as the terms, et cetera, et cetera. We're just aware based on client feedback that that is something that is attractive to certain folks to be able to deposit funds at Robinhood. So rollovers to a Roth IRA, based on the most recent information we have, would be eligible for their 3% match. And obviously, you got to check the terms as far as how long you'd have to keep the money at Robinhood, et cetera, to be able to claim that full 3% match. So the 5 steps would be, of course, qualify. Make sure you're qualified to set up a solo 401k. So you're self-employed with no non-owner, non-spouse, full-time W-2 employees. Then choose a solo 401k provider like my solo 401k financial that offers a plan that supports the mega backdoor Roth solo 401k contributions. And of course, it makes sense to work with a provider like my solo 401k that has deep experience and provides the ongoing compliance support. Open up an account for those voluntary after-tax solo 401k contributions. Determine how much you can contribute. We provide tremendous support in helping customers and educating them on how much they can contribute based on their situation. Deposit the funds into the voluntary after-tax account, then transfer the funds out of the after-tax account to a Roth IRA. So that subsequent transfer from the voluntary after-tax to the Roth IRA is reportable on a Form 1099-R. Now, we handle that 1099-R. That was part of that compliance support that I was referring to as one of the leading mega backdoor Roth solo 401k providers. So even though it's not taxable because it's after-tax money, as long as there's no gains that had accumulated in that after-tax account, it's still reportable, needs to be reported for the year of the transfer on a Form 1099-R. So customers or their advisors just let us know about those after-tax to Roth IRA transfers so we can capture the information that's needed to prepare the 1099-R. And then if the money ultimately ends up in a Roth IRA at Robinhood, you can qualify potentially for that 3% match, which could have a compounding effect. Now you ultimately have even more funds in your Roth IRA on top of the 72,000. Now, what's great is that, or I should say, what's a common question this time of year is, can I still set up a plan here in 2026 and make 2025 voluntary after-tax contributions? And the answer is yes. So even for those late starters that didn't set up a plan by the end of last year, by December 31st, 2025, they can still set up a solo 401k in 2026 and make voluntary after-tax contributions. And as we mentioned, you can just make voluntary after-tax contributions. You can skip the employee, you can skip the employer. So regardless of how your self-employed business is taxed, whether you're taxed as a sole prop, an S Corp, a C Corp, a partnership, you can set up a new plan in 2026 and still make voluntary after-tax solo 401k contributions for 2025 based on your 2025 self-employment income, et cetera, based on the 2025 limit. For example, the overall limit for 2025 is 70,000. Make that voluntary after-tax contribution for 2025 by your 2025 business tax return deadline, including any timely filed extension. So the key is how your business is taxed. So if your business is taxed as an S Corp, that deadline is going to be March 16th of 2026 or September 15th of 2026 if you file a timely extension for your 1120S. Or if your business is taxed as a C Corp or a sole prop, the deadline for 2025 is your business tax return deadline. So in the case of a sole prop, that's really the 1040 deadline. So April 15th or October 15th of 2026, if you file a timely extension for that 1040. So here's a quick example with the math for 2025. Assuming that the individual is under age 50, they could contribute, for example, $70,000, 100%, assuming they have at least $70,000 of self-employment income as a voluntary after-tax contribution, deposited into their after-tax solo 401k account by their 2025 self-employed business tax return deadline, including any timely filed extension, and then transfer it out of the after-tax account over to their Roth IRA. There's no deadline to ultimately transfer to the Roth IRA, but most will want to transfer sooner rather than later so they can start to invest with that potential for tax-free growth. Again, the voluntary after-tax solo 401k contribution, that doesn't need to be reported on the personal tax return or the business tax return. Doesn't need to be reported on the W-2, for example, if the business is taxed as an S corporation. But the subsequent transfer, the second step of the mega backdoor Roth solo 401k strategy, that would need to be reported on a Form 1099-R, but that would be reported for the year of the conversion. So even if the contribution is being made here in 2026 for 2025, since it's being transferred in 2026, it's not going to be reported until 2027 on the 2026 Form 1099-R. And so we have forms on our website that customers use or advisors will submit on their behalf to give us the information we need to prepare that 1099-R. You can access it quickly and easily at mysolo401k.net/forms. And then here, finally, we have an image here just to illustrate how the account setup might look. So you've got a one participant solo 401k. Let's assume they've got two accounts, right? One for pre-tax solo 401k funds. Then they set up another account for making those voluntary after-tax solo 401k contributions. They deposit the voluntary after-tax solo 401k contributions into the after-tax solo 401k account. Then they're transferred out of the plan to the Roth IRA. Okay, great. Thank you so much for joining us through those slides. As always, we really appreciate you joining. If you could take a moment to like and subscribe, we would greatly appreciate that. And that would really just help your fellow solopreneur who might be looking for this information. You might be looking to secure their retirement because that's going to tell the algorithm that the content is valuable. So it helps to get the word out to other solopreneurs like you. We also invite you to subscribe to our channel. We go live every day with crucial content. So you'll get notifications of when we go live. So you can join, you can ask questions, you can check out what we're talking about each and every day. All right, so new my solo 401k customer here. We had a net profit of $17,940. I went ahead and did a $14,000 employee contribution and a $668 employer contribution. Now my CPA says that is too much. That is other clients that have the solo 401ks max contribution 37% of their net income. Is he right, or I over contributed? Well, your ability to contribute depends on your self-employment income as well as the type of contribution that you're looking to make. So, for example, for someone whose business is taxed as a sole proprietorship, you got to take your net income reported on line 31 of Schedule C less 1/2 of the self-employment tax. And we have a calculator on our website that'll run that number. And then of that number, you can contribute 100% dollar for dollar, not to exceed the employee limit, which for example is 23,500 for 2025 or 24,500 for 2026. But that's also going to be reduced by any other contributions that might have been made to another plan, like a day job plan. And then on top of that, you can make an employer contribution of 20% of that same number. So taking the numbers that you gave, which is 17,940, let's assume that that's your net income reported on line 31 of Schedule C. So I'm just running the numbers as far as one half of the self-employment tax. So that leaves you 16,672. And so certainly 20% of that number is more than 668. So that $668 employer contribution would be within the limit, as well as $14,000 is within the limit as well, assuming that you didn't max out your employee contributions to another plan like a day job plan. So feel free to email us at support@mysolo401k.net if you have any more questions. Hopefully that helps. Next question is from Gary. Can I use an existing after-tax brokerage account at Fidelity to make voluntary after-tax contributions? No, it needs to really be an account that's opened up under the name and EIN number of the plan. So you can't use a non-retirement account to make these after-tax contributions. But Fidelity, I mean, they make it very easy. They're the most popular brokerage, for example, for our customers. So we help our customers, for example, open up the accounts at Fidelity. It's a free account. They don't charge anything. There's no maintenance fee. You can invest in a wide range of investments similar to an IRA, whether it's publicly traded stocks, mutual funds, ETFs, etc. Great question, Gary. All right. Well, it looks like that's it for today's Solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this Solo 401k community. We'll be back here tomorrow with more crucial content to help you secure your retirement.